If you followed this channel for any length of time, you know that bank stocks make up a pretty sizable bit of my portfolio. I did the math, and it turns out that banks make up about 13% of my invested holdings. I own 8 different banks. We're going to overview some of those banks that I own right now as part of my series of looking at my portfolio as we approach the end of 2023, starting to make my investment plan for 2024. I'm Jason Hall. This is Investing Unscripted. This video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, go to our special link. Go to fool.com/unscripted. The Motley Fool is going to give you its 10 best stocks to buy right now. You're going to want to check that link out after watching this video. Let's lay the background for banks as I'm pulling this up. 2023 has been an up and down year. Different bank stocks, if you bought near the beginning of the year, if you bought maybe at their peak, which has really been over a year ago, a lot of bank stocks are still way down. Depending on your timing, if you took advantage of some of the opportunity the market created for us in March and in May of this year, some bank stock investments have done well. I continue to believe that high quality banks can be a really great investment, a good bucket to invest in to generate great long-term lasting wealth, as long as you moderate it and consider the risk. Okay, with that said, here are the 8 bank stocks that I own, and these are in order from the largest to the smallest in my portfolio. We have Live Oak Bankshares, ticker LOB, Axos Financial, ticker AX, SOFI Technologies, ticker SOFI, NT Butterfield and Son, ticker NTB, M&T Bank, one of the large regionals in the Northeast, ticker MTB, Truist Financial, the biggest regional in the Southeast, at TFC, then Central Pacific Financial Bank, CPF. That's one of a handful of banks that kind of rule the Hawaiian market. None of the large banks have been able to really crack that market. CPF does a good business there. And then PNC Financials, Mid-Atlantic, based in Pittsburgh. PNC is the ticker there. This is going back over the past 3 years, and we'll take a look at the stocks from their highs, and they're all basically all down from their highs. And the S&P 500 is basically knocking on all-time highs as we're recording. If we go from the beginning of 23, most of them are up. We know SoFi's done super duper well. Its business has really started to kick off. Earnings getting to that net cash flow, net profit, positive profit point as they've spent tons of money to grow and acquire new depositors and new borrowers. They've spent a ton of money on customer acquisition. Their scale is starting to pay off. If you look at the S&P 500, 22.8% in total return so far this year. Most of them are lagging the year. And the reason why that's the case, those of you that might have forgotten, March 10th is when the FDIC took over 2 large US banks. And then in May, the FDIC took over another large US bank in First Republic. So if we go from that March 10th date, you see the math starts to look a little more favorable. The market's still up pretty good, but we're starting to get a few more of these are outperforming. And then if we look from that May date, that was a big deal in terms of things kind of resetting. Again, the S&P 500 since May is up over 13%. That's very good. But then you see every single one of these bank stocks over that short term, they've all turned into outperformers of the market. I really wanted to highlight that because sure, I'm patting myself on the back a little bit here, but the reality is that it's a reminder that when it comes to the banking industry, one of the best times to buy is when there's lots of fear. There's the old statement to buy when there's blood in the streets, even when it's your own blood. I owned a number of these bank stocks during this collapse when stocks fell, when investors were terrified that we were going to see another bank run like we saw on the 3 banks that the FDIC took over this year. And investors were understandably worried. And I decided to take a different approach and look at the FDIC's actions, look at the way depositors were behaving. And besides those banks that had really gotten undermined by bank runs, by and large, most banks were completely fine, right? They weren't at risk of insolvency because of depositors running, pulling all their cash out, pulling their deposits, and leaving the banks with no cash. So you have to remember, if a bank has $100, it's going to keep $10 of that to cover deposit withdrawals and normal flow of money, and it's going to lend out the other 90 of it. That's how banking works, right? We all put our money in the bank, and then the bank lends it out. That's the system. When banks fail is when there's pressure from depositors because concerns about losses at the bank and people are afraid their money's not safe anymore. I took advantage of that opportunity to increase my exposure to several of these banks during that period. As a matter of fact, I'm going to pull up this list again because I want to talk about the banks that I added to during that March and May period. First, PNC, Truist Financial, M&T, These are larger regional banks that I didn't have any exposure to before this spring. And I took the opportunity to add those banks because the market values they were trading for on an earnings basis and on a book value basis just looked incredibly attractive. The risk reward was way too good to pass up. Live Oak Bank shares, I substantially added to my position there. Axos Financial significantly added to my position there. SOFI, I had added to my position multiple times prior, and it's grown to become one of my largest bank holdings. But I wanted to call out those specifically because the market had given me a wonderful opportunity. And what were exceptionally safe banks, again, they're still banks, so with the caveat that they're banks, but exceptionally safe banks to add to and increase my holding. So add it all up, you see the numbers. It's been a great run, right? These banks have done very well for me and for investors that have been able to hold through this tough period and have been able to make money. Let's look forward. What are my expectations going forward? Because again, banks are cyclical. And as an investor, you have to be conscious with cyclical businesses of the risks in the short term of stocks going down a lot when the economy gets soft or investors are worried about the economy or interest rates and banks' profitability or increased regulation, all those things that can push bank stock prices down. Be mindful of that as an investor. Are you viewing it as a trade or are you thinking about a long-term investment? I will say all the banks that I own, I'm viewing as long-term investments. I'm not viewing any of them as trades. They're strong brands. They have some pretty good competitive advantages. SOFI, for example, they don't have a bunch of 2.5%, 3% mortgages that hinder their ability to attract depositors with high yield deposits. Live Oak Bank shares, their lending book is entirely small business loans. They're adjustable rate. Those loans are adjusting up to higher interest rates. Their deposit business is mostly high yield online savers. They have the ability to continue to pay higher yield. It can put pressure on other banks. But you think about the PNCs, the Truist Financials, the M&T banks, they have incredibly strong, sticky, loyal deposit bases. We're finding that I think when it comes to switching costs, banks have incredibly high switching costs. I think it's a pretty durable competitive advantage. Yeah, they're going to have to raise the yields they're paying to depositors some, but I think they're still going to be able to pay lower than average because of the strength of their franchise and their customers are going to feel like their deposits are safe there. So I think there's value they create through that. So I'm not viewing any of these as trades or businesses that I need to sell. Looking forward, thinking about valuation, I think this is really important. We'll have a brief conversation about valuation as we wrap up the video here. And here is the short version. I think by and large, most of these banks are trading for pretty reasonable valuations. We've seen Live Oak Bank's earnings-based multiple has increased substantially. And that's the reality for most of these. We've seen the multiple has gone up. So it's not like their earnings have grown over the past year and investors are bidding up the stock because the earnings have gone up. These were crazy cheap at the beginning of the year. They were cheap because of the fear in the market. So the multiples have come up. But again, I think the multiples by and large are still attractive. You look at some of the less than 7 times earnings for NT Butterfield and Son, which is a slow growth bank, but they pay a high yield dividend that's pretty safe. Then you start seeing these 8 to 10 times price to earnings ratios. Again, that might seem super cheap compared to the 20, 30, 40 times you might see for some growth companies out there. Banks always trade for a lower multiple than the market average. So that's important. But again, these are still really reasonable valuations. I think there's room for those multiples to continue to move higher. And I do think over the years to come, we're going to see earnings growth from some of these banks. Live Oak, for example, they're still very high growth as they expand into multiple different industries that they lend to. And they focus on industries that are growing and that are profitable. So I think there's still a tremendous amount of growth there. You don't see SOFI on here just now moving into positive profitability, but I think it's still fairly valued. Another useful metric we can talk about is book value. And you still see for some of these large banks like Truist, M&T Bank, PNC, they're trading for right around or even a discount to book value. So again, I think these are still reasonably priced. Some maybe even getting borderline cheap. You look at the higher book value, price to book values for Live Oak, NT Butterfield, SOFI, and Axos. A lot of these, Live Oak, SOFI, Axos, these are branchless banks. So they trade for higher premiums to their book value because they don't have these expensive physical branches to run with all the costs and the liabilities that come along with that. So they're more cash efficient, they're more profitable because of their structure. And then NT Butterfield and Son typically trades for a pretty high book multiple because of their structure. They have fewer branches because they're more concentrated in Bermuda, Cayman Islands, Channel Islands, serving ultra high net wealth clients by and large, and businesses in those markets, a very high cash efficient sort of operation. So again, thinking about all of these from the perspective of looking at the results, thinking about the cyclicality of the banking industry, and making sure to be mindful of the risk in the short term and thinking about long-term opportunity. I don't see any of these as being sell candidates right now. They're great brands. They have really strong franchises, well run. I think the higher interest rate environment is starting to show that it's going to be generally better than worse for most of these banks. I think that's going to continue to play out over time as a positive. The market's going to get more and more confident in banks and less concerned about a crisis. And then the multiples are going to come up as a result. And I think they're going to be worth continuing to own. I think you look 3 to 5 years, any one of these banks is worth owning, worth making a part of your portfolio, whether you're looking for growth, building your overall wealth, or you're looking for income. There's something for everybody, every different kind of investor out there.